give me your credit card, I'll get a pair of scissors, I'll cut it up. We're baking in probably 2 rate rises this year. Mate, just accept the fact that this is moving to an exclusively non-bank space. I dare say commercial is probably going to be another hot topic for this year as well. I'm here to make you money. And that's why as a brokerage, we speak different, because who cares about 0.05% on an interest rate if we're talking about the property increases in 100 grand. G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. 2026, we're kicking off in our new studios. I'm excited. I've got Nate Condy here from our team. Anyone that's listened to previous episodes will know that Nate is the weapon that does all the numbers. So when we're talking about putting loan strategies together, he's my chief strategist. So if you're dealing with me, you're generally dealing with Nate as well. G'day, mate. How you doing?
Good. Thank you for having me on again in the new studio. It's very official.
Exciting.
Yeah.
It's exciting.
Yeah.
Mate, speaking of excitement, you've had plenty going on in your life off the field.
Yeah.
Mate, if we rewind, a couple of months, here we go. Married.
Yep.
Bought your own home.
Yeah.
How old are you now?
27.
You're 27.
Yeah.
2 investment properties.
Yep.
And your own home.
Yep.
And married. That's insane. I get proud. You've been with us for 4 years?
Yeah, just over 4.
Over 4 years. So coming in as a 23-year-old, seeing where you are, it's like seeing my son grow up, mate. I don't have a son. But honestly, you if anyone thinks that things aren't possible, you take a 4 or 5 year horizon.
Yeah.
And mate, what you've done, obviously, I'm not here to blow you up, but I think the message here is when there's been some intentionality, when there's been focus, singular focus, look what can happen in 4 to 5 years, right? And,
yeah, definitely.
You never beat your chest, mate, but I think when you look back, you'd definitely be proud of what you and Kelsey have done. And if you're connecting some dots there as well, Nate has married his co-worker, Kelsey. So look, we will take some, what do we say, mate? We'll take some
credit.
For you guys coming together, mate. But it's been wonderful. I think coming into 2026, it's like we never left, mate, in 2025. Don't you feel that way?
No, there was no break.
There was no break.
Yeah.
We've literally come back. The phones are ringing. The inquiries are red hot as well. And we've been growing our team in the sense that we need to build the army so we can really cater to people like the listeners that are tuning in, ambitious Australians who want to build their property portfolio. We are talking to you. This episode will be a roller coaster because I'm not going to hold back at some point because I feel like this is a very closed space for us to have a chat. And if you're tuning in, then I'm going to make this worth your while as well, because we're going to unpack quite a fair bit of what's happening in lending, but also what's to happen this year as well, based on our years of experience. So stay with us because we're going to cover a fair amount of turf today as well. Where I really want to kick off is current state of play. So as of kind of February 2026, what have we seen? And I'd say probably the biggest talking point is all the changes around trust lending.
For sure.
Give us a rundown, Nate, of kind of what we've seen, because you'd say that Macquarie Bank was the first pillar to fall, right? And once they moved, everyone really took notice of it.
Exactly. Pretty much all the majors are out of that space at the moment. There's a few still in there with very specific caveats to get into that product, so it's pretty hard. So it's pretty much a non-bank space at this point.
Yeah, here we go. And that's generally what we're saying. Any client calls I'm having is, mate, just accept the fact that this is moving to an exclusively non-bank space. And that's a good thing.
Yeah.
It's a great thing. I say the major banks are not here to build your portfolio. Like get that out of your mindset that I'm like, if you partner with a major bank, fantastic. Stability, security, great internet banking, for example. But if you can get past that and you go, I want to be a portfolio builder, you've got to engage with non-bank lenders.
For sure.
Yeah. And there is a pay-to-play model. Naturally, the rates are higher. I think the younger generation, like you guys, anyone probably under 35, for example, is cool with it because you go, mate, there's no stigma or less stigma attached to it. I think where I am in someone in their 40s, probably saw in the global financial crisis circa 2008, the non-bank lenders were a little bit hit and miss. Like they jacked their rates up super high. They're a little bit volatile. No one knew who they were in terms of household name. But you talk Pepper, Bluestone, Liberty, Resimac, First Mac, Brighton, mate, you just keep going through this name and people go, oh, mate, I've never heard of them. And that's okay. As an investor, mate, you're buying in areas that people have never heard of sometimes, right? As emerging markets. So in terms of breaking ground, take that as a bit of a if you pick up what I'm putting down, take that as something to run with, going, who cares where your money is coming from? The risk is on them because they're lending their money to you.
Exactly. They're the one giving you the money.
Great. Someone else is going to come and swallow them up. And that's generally what happened after the GFC. A lot of the smaller banks were swallowed up by the bigger banks. They have better balance sheets. The loans just poured it across. So if that's a reason that you don't invest, I want to challenge you on that to say, let go of the lender name, let go of the rate. You're buying properties, you're not buying loans. And and this kind of came to me over the Christmas break. I think once you have a bit of space to think and slow down, I kept kind of looking at what's our point of difference, Nate? And like, why do we talk different? Why do we act different? It's because the majority of mortgage brokers are here to save people money. That's how they kind of cut their teeth or put their value proposition in. Whereas we're here to make people money.
Yeah.
And that is a monumental shift in the way that we do business, which is we're talking about making money. Why would I try and save you $50 a month on a rate to refinance you back out to a 30-year mortgage, roll over the loan for, and all the fees? We don't ever refinance, very, very rarely. I'm here to make you money. And that's why, as a brokerage, we speak different, because who cares about 0.05% on an interest rate if we're talking about the property increases in $100,000?
Yeah, exactly.
In a year's time. So, again, I'm dropping nuggets here, and different people respond to different parts of what I'm saying. But again, I just want to kind of leave a bit of a cookie trail here to go. If you are interested in growing the portfolio, if you're interested in building wealth for yourself, you need to build an elite level team around you. But let's come back to trust lending. So Macquarie Bank came out, and pretty much when they make changes with banks, we get no heads up. We get no prior notice.
Yeah, no, it's usually as of tomorrow.
Or even this afternoon.
Yeah.
And we'll see this, I'm going to skip ahead, but we'll see this when we have when rates go up as well. When rates come down, rates are coming down effective in 2 weeks' time. When rates go up, they're effective immediately. Yeah, and particularly what happens around fixed rates even as well.
Fixed rates more so, like with the variable, we get the RBA meeting and then it's on.
Yeah.
It's usually like, maybe a couple of days. Fixed rates, it's no warning. At least with the RBA variable rate, you get a bit of, where it's kind of going to go. But yeah, with fixed, you could have one strategy in place and then the next day it's all over.
Correct. And this is where we're talking a little bit of nimbleness. We talk about trust lending and, okay, we're here with this bank. They've shut up shop. We need to move banks. And I think as a really good investor, the top tier investors that we see, they don't get offended by it. They don't get rattled by it. You just pick up, you move shops, for example, set up there, knowing that they may move the goalpost. You pick up and you move on as well. And there's a level of adaptability that we see for our top tier investors versus the ones that get derailed. They take it almost personally.
Not a victim mentality. That might sound a bit harsh, but yeah, the top investors are just more resilient, right? They just get on with it and say that's just how the world works.
There's a lot in that. So we'll go back. Macquarie Bank, then it was
CBA.
Yep. CBA came out, said, well, you've got to be an existing client
for 6 months. Yeah. It was existing home loan customer. So you can't just have like a transaction account with them. You've got to have, an existing lending customer. So home loan, business loan, or credit card.
Yep.
For at least 6 months. Now, if you're a couple and even one of them's not, say one of them's got a credit card but the other doesn't. Tougher.
Cookies. Yeah, right. Yeah. So again, CBA just signalling going, we're making it harder. And even for me, because I got one of my trust loans with CBA, they came back and were asking for all these documents like directors, shareholding certificates. I'm going back and forth with our accountant, for example, to try and find it, because I think they're then as like going back and doing all their due diligence on actually who they've been lending money to as well. So don't be surprised if they actually come back asking for more information after the loan has settled as well. Yeah. So then we saw ANZ.
So before that, St. George and Westpac came out, and they're going into pretty much just exclusively business banking, which makes it very, very tough to deal with, and put LVR restrictions on it as well. So they were, I guess, a mini announcement that was kind of always there, but once CBA and Macquarie came out, they tightened it a bit, and then we saw
and then we saw ANZ go to 70%
Yeah.
as well.
And existing home loan customers.
Existing. That leaves who we got, and then First Mac have non-bank lender. They've announced some changes as well.
Yeah, Resimac have announced changes. Everyone. It's going to come from everyone, so it's just a matter of time and who can adapt the best.
Correct. So again, if we're talking about experience, for example, and us having been through a few iterations of lending changes, this is almost like SMSF, so self-managed super fund lending. I remember I used to be at Commonwealth Bank when we had SMSF lending. They pulled it. The compliance was too much risk, and they said not our core business. And then it went exclusively to non-bank lenders. So when any clients are going to do SMSF lending, we're taking the banks buddy they've never heard of. Yeah. And that doesn't seem to deter them because they're just going, right, I only have my pick of non-bank lenders, with the exception of AMP, who's recently just come out saying they're going to move back into this space, which is very interesting as we look for the year ahead. So if you're trying to grow a portfolio, the message that we're trying to hit home here is don't freak out about the lender, care less about the rate. Remember, we're buying the property here as well.
Yep.
The other big one that we're waiting for is this mysterious debt-to-income ratio announcement.
Yeah.
Here we are, February, and APRA was saying we're going to make these changes effectively from February, and we've seen no comms.
Nothing.
To come out. More clients have actually contacted us than banks have contacted us about changes around DTI. DTI is a metric, so there's a raft of metrics that when we're putting our numbers through banks calculators or we're trying to structure a portfolio, we've got what's the net monthly surplus? There's one. There's your DTI as well, which is kind of how leveraged you are. And if there's something on your radar, good to know, but I'd probably have less bandwidth about it personally because, again, if we're talking about dealing with non-banks, the major banks will come in. Again, they're signalling we're not here for investors to build massive wealth. We're here for majority of Australians to buy their own home and maybe an investment property or two. Yeah. So if you're trying to scale a portfolio, forget about the DTI being a handbrake. Just find a way around it. Something that's probably surprised us even a little bit for this year is the talk around rates going up. And we're baking in probably the potential of 2 rate rises this year is what we're being told. But inadvertently, when rates go up, borrowing capacity comes down. What's the typical reduction on
what do we say? About 1% increase. So let's halve that if we're expecting 2. About 50K.
There we go.
50K impact.
I had about 48K on my numbers. So a drop in 50K on an average household borrowing capacity. But prices, when I looked at Westpac's announcement, saying prices will go up by at least 80 grand on average. So you'll lose 50K in borrowing capacity, but prices will go up on a median 80 grand. That's 130K difference potentially, puts you out of the market when you do your numbers. And again, we're going to be very careful about where you get your information from because bank economists get it wrong. The RBA, they're looking at multiple metrics, for example. If you're looking at, okay, what's my borrowing capacity? To take a 50 grand, to replace 50 grand reduction in borrowing capacity, how much is a credit card drop borrowing capacity?
So for every 1K of limit, say 5 to 6K of borrowing, you lose. So what's that? Call it 9-10 grand.
So if you got a credit card, if you got a credit card of $10,000 and you got rid of that 10K credit card, you've automatically put 50 grand of borrowing capacity back in. Yeah. So if anyone says to me, I'm worried about rates going up, give me your credit card, I'll get a pair of scissors, I'll cut it up and go, there's your borrowing capacity back. Thank you very much for coming. I don't want to hear it. Yeah. This year, I'm going to be so firm around credit card limits that I'm like, take this as the warning, potentially. Take this as a friendly warning because when we're doing loan strategies and we're trying to buy properties, which are income-producing assets that compound, and you are sitting here attached to a stupid credit card that maybe you'll get some points on, I've got to ask the question about how serious you are as an investor.
Yeah.
It just does, to me, it just doesn't make any sense. If you are trying to build wealth, show me the reason to have a credit card. I don't get it. Well, in fact, you close the credit card, cut it up. Once your loan's approved, go and get a new credit card, for example, if you really want to play that game.
The new bank's going to try and set you up with one probably anyway, right?
Bring them. I mean, I don't want to pay the fee. They'll waive the fee. I know every time I do it, they throw in bloody bottles of wine. They'll waive the fee for a year. So if you want to channel your energy and efforts, don't channel the energy and efforts into challenging us on the credit card. Go to your credit card provider and work that limit out. But I'm going to say, if you are talking about rates, if we're talking about rates going up and you're still attached to credit cards, I'm just going to serve this podcast episode to you and go listen to this and then come back to me, because you're barking up the wrong tree when it comes to credit cards.
Yeah.
Car leases are my next one. I'll like lock in on a radar on car leases. And again, we're talking about a depreciating, I don't even consider cars assets. I consider them liabilities, depreciating liability that's costing you money, and you're going to balk at a investment property which is income producing and you're out of pocket. Again, find me a broker that's challenging you on that. And I'll tell you why brokers don't challenge them on it, Nate, is because they're making money off the asset finance.
Sure.
Yeah. How much asset finance do you reckon we've done?
None.
Yeah, correct.
Very, very little. Or we refer it out, right?
We refer it out. And how much do we refer to
expert.
Chanel?
Not a whole lot. But
And the only ones we do is someone self-employed that
Correct.
actually makes sense in
Equipment.
their business.
Like,
Equipment
yeah.
finance. Here we go. I don't do car loans. You can have a look at my loan book. And that's how open we are around it. Asset finance, mate, we can make the same money off a 50K car loan that we would off a 500K home loan.
yeah.
But I refuse to do it. Commercially, it makes sense. They're always knocking on our door saying you should be doing more asset finance. I refuse to. And that's where I think there's strength in like character, and there's so much. I'm not saying that we're some pious type of organization here. I'm just saying we're so values driven. Why would we do something that goes against the value of what we stand for?
Yeah.
Yeah. I don't finance my own vehicles. If I want to buy it, I have to buy it in cash. That's the rule. Even though I get some type of tax benefit according to my accountant, I don't care. Every single dollar that I've got surplus is going to go into property portfolio building, not into motor vehicles.
Yeah. The other one we get, not just the standard car loan, it's the novated leases where they want to, save on tax here and there.
You want to save
It's
on
like-
tax and do negative gearing.
Yeah, exactly.
Challenge you on that.
Mm.
Keep going. Sorry, I interrupt you.
Well, it's the same. It's kind of the same mindset of the self-employed applicant, where it's like, oh, I want to reduce my profit, so
Yeah.
I don't have to pay as much tax. Well, then you can't borrow as much,
Correct.
right? So get rid of the car loan. Stop trying to, skimp on tax. That might be hard to hear, especially as someone that's not self-employed, but
But I mean, you still pay. I mean, on your income, mate, you'd be paying a large amount of tax.
yeah,
Large amount of tax you'd be paying. But what's the point in trying to reduce the tax to lose money? Why don't you just go and earn more money, make more money,
correct.
pay more tax, and you've got different problems that you're facing. And
Exactly.
when brokers are speaking about trying to reduce your repayments, accountants are trying to reduce paying tax. If that's the only value that they're adding, that's small game stuff.
Yep.
When we're talking about trying to build wealth, that's why I think there's a lot of BAs that have really taken off, because they're talking this language of building wealth. No one cares about trying to save $20 a month, because if I save $50 a month here, I'll probably spend it somewhere else. That's just how households work, mate.
Yep.
I've got two small kids, mate. Well, I think 2 slices of toast at a cafe and a couple of coffees and we spent $50, right?
Yeah.
So trying to save it makes very little sense. What I'm trying to do is actually put that into a compounding asset as well. So, sorry for jumping all over the place, but some things will definitely get me fired up, particularly around the discussion around rates rising. I think probably where it has a little bit of weight to it is when people have existing lending and now across their portfolio,
Yeah.
they're going to start to see, if you're already hemorrhaging cash at the moment and we're talking about rates going up, probably the only way to mitigate that is a fixed rate. But as an investor, a fixed rate sometimes can be counterintuitive because it locks you into a bank. Then you can't refinance or you can't strip the equity, for example. So you've tried to solve one problem by managing cash flow. you've almost created another problem, which is now I can't move banks.
Yeah, and no offset. If you say rent vesting, right, and you got a large chunk of cash you want to put in offset, you can't.
Correct. Or you'd have to split the loan up.
Yeah.
You've got, part fixed, part variable. Then we're spending half an hour on a discussion going, well, how much do I fix and how much do I have variable?
Yeah,
mate. The time that you spend on these discussions or doing your computations, mate, you just put that into your day job and try and earn more. Is what I say to people. And if you're waiting for the market to slow down, I've pretty much got bad news. Like, most of the markets that we're talking about with BAs nationally are tipped to rise. And you can pretty much thank the first homeowner grant for that, the 5% guarantee scheme. That's a mad handball to anyone that's bought property. That just gave us a leg up. Like, you probably saw your properties rise in value.
Yeah.
Everything that we've got at the moment, every time we're doing vals on our stuff, it's going up. When you talk about a 5% no LMI a leg up to get into the property market, geez, mate, they haven't helped first home buyers. They've probably pushed more out the market than helped sometimes. Cool. Coming into, I guess, what we're seeing, this is probably why you're tuning in, is going, okay, guys, tell me what I need to know about, the market for 2026, or how, I can really push ahead with my journey as well. You've heard me talk, about the 3 pillars. There's 3 pillars that I see when it comes to building a portfolio. Number 1 is your borrowing capacity. That's generally why, if you're starting with a broker to go, what can I physically borrow? The next one is, well, how much deposit do I need, or what equity do I have in my current property? So we're talking about equity/deposits. And the third one is cash flow. And generally, when I'm speaking to any new client call, and you hear me on the phone all the time, is I'm like, which of those 3 problems are we trying to solve? Which is priority number 1? So priority number 1 is the borrowing capacity. We're cutting credit cards. We're looking at rent vesting strategies. We're what else have we got? HEX, for example. Any of these handbrakes that are limiting people's ability to borrow, we're finding that out. When it comes to equity/deposits, we're then going, okay, how many vals can we physically do? And so when someone's got 4 or 5 properties, mate, you're doing what? At least 8-10 valuations
per property.
Yeah. So what's that? 8 times a 4.
It's nearly 50.
Yeah. And the time that goes, and I think that's what happens when we're talking to clients, going, mate, you don't see this, and this is obviously our gig, but we're showing you what's involved. And there's generally why a lot of brokers won't tackle this, because there's so much time intensity involved in just doing okay, where are we at the moment, current state of play, before we start, really laying the foundations for that roadmap, that strategy work. The importance of vals. I mean, when you're doing 8 to 10, people going, well, why are you doing so many?
Yeah, because they're all over the shop. There's some high, some low. Just who cares about the rate, right? Get the equity.
Yeah.
And the chances are, when we're doing that many, there's going to be some outliers that will allow you to do it.
Yeah.
Especially, as you said, the market's going to go. Even if we can't get it now, wait a few months. They update every 1 to 2 months, depending on the lender. We'll be able to check again.
Great. And this is a two-way street. So sometimes, obviously we'll try to remember as much as we can, but we're telling clients, like, okay, when you're ready, come back to us. And I hear this all the time with, people saying my broker relationship is a little bit flawed or broken. I'm like, well, when did you pick up the phone or call? And if you're not getting communicated back to, that's a problem. But I think it's also a two-way street, because we can't be mind readers in terms of when our clients are ready to go next.
Yep.
Reach out. I'm ready to make a move, for example, and then put the ball back in someone else's court. But I think if you need to initiate that, just remember, no one's a mind reader. Same goes for my accounting, for example, or when I want to buy next with a buyer's agent. Sometimes the responsibility or onus is on me to initiate that, to get the ball rolling. Correct. As well. Yeah. Look, mate, as part of valuations, I think this is where we can't trademark this, but we can certainly own this space, which is what I call strategic equity strips. And this is very much a proprietary blueprint, is what I call, is our IP that we sit on, because I very rarely have heard brokers speak about this. So let's take the example. I'm going to try and give some basic numbers, because this is a hard concept to explain audio-wise. I've got $1 million property. I've got a $500,000 loan. Okay. So again, if you understand that banks will end up to 80% of the valuation, so 80% on $1 million is $800,000. And like I was saying, we've got a $500,000 home loan. So at this stage, you have $300,000 worth of available equity to you. Now, generally what we see is most people go, right, I'm going to pull that full 300 out. You got a different model.
Yeah. Rather than getting out, well, particularly if the property's in your personal name, rather than just going to get all 300K of it, split it up. 2 properties at 700K will be, it's lucky you gave me that 300K, so it works really well for this example. 700K is a good price point at the moment that we're seeing. Yeah. Using a 10 to 12% deposit plus stamps plus BA fee, you're looking at around 150K. Yeah. Rather than going and doing the 300K equity strip, if there's only, say, one lender that'll give you the borrowing when you've got that extra 300K in there, well, is there another lender that'll give us the borrowing capacity for the purchase when you've only got 150K of extra debt? If so, get 150K first, do your first purchase, and then go back, do the second equity strip, do the second purchase.
Great. And, mate, it's not easy because there's rework for us as a team, right? So what we're trying to say here is, not convenient for us, but we're trying to get you guys the outcomes, right? And multiple apps, there's so much time involved in actually doing application forms. Get back out to you guys as clients, sign it, back out to the team. You can imagine doing loans at 150 grand. There's zero margin in that as a team. Zero margin, right? In fact, we're losing money on those type of deals.
Especially when they're offset for half the time anyway,
correct,
right?
We don't get paid. I'm going to be so straight up and blow this open. We don't get paid because the loan that you've used is going to be completely offset. The bank will not pay us. Yeah. So when we're doing these things, it's with such a straight bat that we're playing. There's no commission breath about us. That's with people listening, that's why I talk about loan strategy fees. That's why we charge a fee. Yeah. Yeah. It's all above board. And if you don't pay for something, you don't value it. We value this IP and this knowledge because we've taken years to kind of cement and build this and really build a niche for ourselves in that property portfolio building space. So some people will try it. They'll go back to their broker. We've seen it. They go to their broker. They can't do it. They come back to us, for example. Yeah. And we're saying, guys, this is the secret sauce. And when you come to this restaurant, you get this particular meal, right? A signature type of meal that we're serving up here at this call it restaurant. And I talk about strategic equity strips, and I've been very cautious to kind of put this open publicly because other people start talking about it. But this is this whole abundance mindset going, we can show people how to do it. I'm not sure your broker can do it or they know how to do it. Find the right team that's going to get you there as well. So that becomes crucial. Mate, next one is, and this will probably get you going, in 2026, how many portfolios do you see that are cross-securitized?
More than should be.
Yeah.
And by that I mean even if there's one, it's too much. Yeah.
I mean, we're still trying to figure out why.
I don't get it. I think is it laziness on the broker or the banker's part, or is it selfishness that they want? I don't know. I don't know.
You're still getting paid as a broker, you're still getting paid whether it's crossed or not, right? We just can't seem to understand why. Maybe a broker that does it can tell me why they do it.
Yeah.
I think it's easy because you just put one application into the lodgement system, like the data entry. I don't know, mate. And some people don't even know. They'll come to us and we're doing their portfolio and they go, oh, we need to uncross these properties. They're like, what are you talking about? I said, mate, these are all cross-collateralized, and they had no idea.
Yeah.
So if you're listening, I don't think you take that to heart because sometimes you inadvertently wouldn't have known. Sometimes people have asked the question of their broker. They've said, no, it's not happened, but it actually has happened. We're at a point where we just go, look, that's the past. It's got you to this point, but what got you to this level will not get to that next level. Now we need to uncross properties. Why? Well, we want each property to be standalone. It's great housekeeping when you know how much interest or which loans attached to which property.
Yep.
That's good housekeeping. The next one is if we need to take this property to this lender, that property to that lender based on different valuations, for example, or the way that the banks treat the debt, that is why we're doing it. So again, there's reasons to do it. We're not here to refinance loans just to get paid. We hate doing that stuff. We're trying to say, how do we build and create the portfolio in the right scalable way? This is the why.
Yeah.
Cool. Like I mentioned, self-managed super funds. The reason why I say that this is becoming super popular is because if I'm holding properties in my in my personal name or through a trust or whatever it is, I'm feeling that negative cash burn to maintain the portfolio. Whereas in a self-managed super fund, one, there's usually cash left over, so that's considered an offset account. Two, I'm regularly topping up my super on a weekly or fortnightly basis, for example. So I'm not feeling this negative cash burn, right? So you're probably seeing that we do quite a fair bit.
Doing heaps, yeah. And I think if you've got anything balance over, I mean, we've done with lower balances than 150, but anything 140 plus, just come and see what you can do. Like it's a quick strategy to put together, and yeah, it's a great way to, as you said, not feel the burn. Or once you're capped in your personal name or in trusts, it's just another lever we can pull.
Spot on. And do you know where I find like it's the best of both worlds is when someone wants to buy their owner rock. Like let's say, for example, you didn't have your investment properties beforehand and you want to buy the owner rock and you're like, but I still want to buy an investment property.
Yeah.
Well, buy the owner rock in your personal names, mate. Have a good life there because you want to have your own home. But then go and buy an investment property through a self-managed super fund. Damn, best of both worlds. And you'll be able to buy your own home and an investment property. The investment property is compounding in the background. Play on. I think to me, I think every person that buys their own home should be thinking about supplementing that with an SMSF investment purchase as well.
For sure.
Great. And like I mentioned, AMP is coming back into the market. So again, we'll probably see some real competition pick up in this space.
Definitely, I reckon.
Yeah. And so AMP yet to kind of give us all the deets about that. We do a fair bit with them anyway. And be very interesting to see as this will become more mainstream now, is what I say. SMSF lending. Sitting off the back of that, commercial.
Heaps of commercial going through at the moment, more than we've ever seen on our end. It's awesome.
I think clients are getting you probably go back 4 or 5 years and there was a couple of really good buyers. We've had Scotty O'Neill on, we've had Steve Polisi, for example. There's a couple of BAs that we see in this space as well. I think one, as yield like residential yields have softened. That's one. I think the second one is, as you can probably get into a commercial property, seeing stuff under $1 million.
Yeah, definitely seen some coming through. It's just the cash flow. Like when you're so heavily, I guess, leveraged in residential, just offsetting that with a commercial. Obviously, speak to a BA, they'll be able to map it out well for you. But the impact that the cash flow, the positive cash flow on the commercial, because they should be positive, compared to your negative residential portfolio, it's going to be massive. There's just the barrier to entry, and it's a bit of not a myth, but people thinking, I need a 30% deposit to get into it. You don't. There's some lenders, the non-banks, they'll allow you to get in with a 20, particularly in your SMSF as well, is what we're seeing a lot of people go down, getting commercials in SMSF. You can get in with a 20% deposit there too.
Great. I mean, we're doing stuff. I had to catch up with Bank of Queensland the other. They'll do 90%. I mean, outside super, for example, on a commercial, even as well.
Didn't even know that.
Yeah.
That's awesome.
I was blown away. I was like, that's insane. I mean, even NAB will let you go up to 100% on against your own home.
Yeah.
To link that to a commercial property as well.
As we've just talked about, not cross.
Not cross. But that's probably, again, we see some areas where, okay, that does make sense because you're tying it in with a commercial and they want that extra security of residential. And again, this is not for everyone, but if you need to scratch this itch and go, well, what are my options? Find something that's going to suit you. It doesn't have to be a square peg round hole solution. What we're trying to say is this the right option for you? And here's some things to consider. So I dare say commercial is probably going to be another hot topic for this year as well.
Definitely.
I keep coming back to this, but the amount of times cash flow becomes part of the discussion. You probably do a loan strategy show, mate. Here's the pathway to get 6 or 8 investment properties. I've seen these strategies go out the door. I'm like, holy, that's incredible. Jump on a call and I should be down. I thought the clients would be excited. And the first thing that goes, man, we can't, after 2 or 3 properties, we're redlining, cash flow, we can't maintain this portfolio. So I say to them, and I see this all the time, a BA could show you 5 or 10 properties that would be absolutely cracking to put in your portfolio. But if you can't afford it, what's the point? Yeah. Cash flow is not the buyer's agent's responsibility. They'll give you a simple Excel sheet. They'll show you the property. It'll look good. But generally what happens, the reality is there's negative cash holding on the first couple of investment properties, particularly when they're at 100% or 90% leverage.
110, because you're getting the equity, you're paying the 20% or whatever deposit plus stamp duty. Yeah.
So don't expect this property to wash its face magically. Like any client that says that, I've just got to give them, a gentle uppercut to go, mate. Don't expect that. And if you have those expectations, leave them at the door, that this property's going to magically wash its face. Yeah? That's one. The next one is, well, they keep knocking on doors to get the magic answer around how to maintain this portfolio. Honestly, it's not our responsibility. As a broker, I'm here to get the loan approved and help you with borrowing capacity. It's not your buyer's agent's responsibility. It's not your accountant's responsibility that they can suggest do a PAYG withholding variation, for example. Financial planner is probably the only one that I think could actually help you with this.
Yeah.
But a financial planner at that point is probably going, well, don't buy the property, and that's counterintuitive advice.
Yeah, they're not responsible. They can help you, but the financial planner's still not responsible, right?
This is a you thing.
100%.
Yeah.
Cut down your expenses, increase your income.
Yeah.
Because I get asked, how are people doing it? What's the magic formula? There's none. There's no magic formula to it. They either funded a lot of their deposits with cash, so they're not as heavily leveraged. But if you're in this environment, if you're at 100, 105, 110% every property, you're going to be negative.
Yes. And especially if rates go up.
Yeah.
It's going to get worse.
Yeah.
Yeah. But this is, again, as rates go up, this will be our time to keep buying. There's no doubt about it. I'll keep buying, particularly, if or when rates go up this year, it'll be the time to come in because it'll push out all the fringe investors and the ones that are actually serious about portfolio building. Rates up, down, sideways, whatever it's going to be, it's always a good time to be investing.
Yeah.
Always. And the ones that can hold through, we've spoken about eating glass plenty of times as well. I'm sorry. Yeah. I will be empathetic to some degree, but mate, I have felt negative cash burn up the wazoo, and it has kept me up at night. And the only way that I could get through it was literally to push through, look at my budget, take out stuff, and work a bit harder.
Yeah.
Yeah, and I know you've been the same as well. And I say this all the time, you can't grow broke. You cannot grow broke. People spending 20 odd grand for a buyer's agent. Well, if you're that concerned, then you do the buyer's agent, you do the locate, negotiate, and save yourself 20 grand. But the problem is time will go on you trying to do it yourself.
Yeah.
And we see it, mate, the amount of times that we roll these pre-approvals, second, third, fourth time rolling pre-approvals, they're DIY investors.
Yeah.
Pay your 20 grand, mate, get a job, I don't know, stacking shelves, whatever you need to do to supplement. One of the guys in our team works Bunnings.
Yeah.
Yeah, I've seen team members that have extra jobs just going, supplement some cash flow, just so it's staying the positive. Alrighty. Moving through to the next point. Buyers agents not getting clients pre-approved. Do we need to get on this soapbox or what?
I don't know. I think yeah, I think we do.
Yeah.
Because it still happens, and we've talked about it on the podcast before, probably multiple times.
Heaps.
Yeah.
Yeah. It just reeks of commission breath to me. I can't hold back. If your buyer's agent isn't getting you pre-approved, I've got to ask the question why. It makes no sense. It shows a lack of respect for the process. I've got to say, Sam Gordon and the team probably lead the charge.
Yeah.
Dawn Fui, I say, is great. Quite a few other BAs make this part of their process. They will not take on a brief until they see a pre-approval. For most of the BAs, all it says to me, I just want to get paid. I do not care about anyone else.
Yeah.
And it's hard to hear if you're some of the BAs tuning in. I just got to challenge you on it and go, mate, why on earth would you take on a client if you're trying to build a portfolio and not get them pre-approved?
Yeah.
And then you've got to ask for extensions around finance, chasing up the broker, the amount of rework that's from a legal perspective. It's like, I don't care about anyone else. I just care about getting this property for this client, and you guys can all just do your job. But the level of rework and stress that it's adding to the client's life, that's not solving a problem, it's creating a problem.
Yeah, and if you're a client that's working with a BA that is doing that, call them out, because as Aaron said, well, as we've both said, the trust space is all non-bank lenders now. So if you're buying in a trust, it's not going to be fast. It's going to be slow. These lenders are slow.
You've got to get the trust set up sometimes.
Got to get the trust set up. You've got to get the pre-approval is going to take 2+ weeks to come through with some of these lenders.
Yeah.
And then once you're approved, it goes back into their queue. Get the valuation done. They're slow. They're not quick. And now that all the majors are pulled out, they're getting even more volume pushed towards them. So they're going to be even slower. You need to be ready because, as we're just going to be asking for extensions, and it's not fun for anyone.
Well, then what happens is, and we keep going downstream. So if we're asking for extensions on finance, that means we're still on the clock for a 4 to 6 week settlement.
Yep.
Now we're chewing into the settlement time frames. Then you got to go probably get independent legal advice.
Yeah.
You got to paper sign documents because they're not digital documents to sign. Get them back to a lender to then check paper wise. This is 2026 and this is all the stuff that happens human touch wise, not digitally. And then you got to try and book in settlement and then do your pre-settlement inspections and all the chops and changes around there as well. Guys, girls, rely on our experience.
Yeah.
This is not the first time we're doing this stuff. Yeah. Not the first time we've bought for ourselves as well. Success leaves clues. Successful investors get organized. If you're listening and you want to scratch the itch, why wouldn't you get organized and why wouldn't you get pre-approved?
Yeah.
Again, it goes back to the whole credit card thing. If you're saying something, you want it, and your actions are saying otherwise, I've got a question: how bad do you want it? It's like going to the gym and eating a crappy diet. It's like, well, how serious are you about your results? It doesn't make any sense at that point as well. So I call it out. I call it commission breath. I see it all the time. Broker land as well. Speaking of like slinging mud, anytime we've spoken openly about this stuff, guys, I live in a glass house. I do not throw stones. We're not perfect. But what I see a lot of, particularly on social media, is, and I didn't even know this term existed until we spoke about it the other day as a team, rage baiting, where it's like putting down, so broker v broker. That broker's crap. That broker doesn't do this. And all it is pick me, yeah? Adding very little value to the equation, just going, they're crap, pick me. Well, why are we picking you? We've just talked in this podcast about all the value that we're adding. And when people look at the strategies, like, even in the calls, they go, man, I've never heard a broker speak this way or a brokerage speak this way. You maybe just walk different, talk different, act different, right? We're not saying that. None of this has ever said pick us. In fact, I've got a couple of brokers that are probably lined up to come on the podcast at some point, because we just don't care about who people choose as long as they've got a great team.
Yeah.
Yeah. We're never pushed anyone that's been a guest on here to go, hey, you have to contact or have to work with them. We're just trying to show you good professionals as well. So, yeah, when I hear the broker v broker stuff, I'm like, this is bottom feeding stuff. We see it in the BA space. They're just like, what do we say? They're just throwing grenades at each other.
Yeah.
Taking digs. And I just get on with your business and don't worry about, putting down your competitors. And then I see it with the BA v broker space or broker v BA space. Like, I know more. It's like, well, I know more. It's like, well, hang on. You're the property specialist. We're the loan specialist. The accountant is the tax structure specialist, and the planner is the strategy specialist. And everyone's got a role to play as part of a team. And I think when you're talking about the team coming together, an elite level team, they shouldn't be contradicting each other. No. Yeah, and we've got some really wonderful partners.
Yeah.
Mate, some of them you don't see on social, some of them you lay very low, but they're just so good at what they do that it's like, hey man, just quiet achievers. And even some of our top portfolio clients, they will not come on the podcast. I've asked them. They won't come on because they're just such quiet, silent achievers, just going about their business, building their portfolios, because the second they put themselves up a little bit, people are going to shoot them down. And it's tough because they've got such great stories to tell, but the tall poppy side's keeping them away from kind of sharing their results. So I don't mind it, being a closed loop like this where we can have these great conversations with you guys. And when you reach out to the back of that, you're seeing a real values alignment in terms of what we're about as a team, what we're about as playing the long game as well. Like I said, there's nothing commission breath about us. If loans are good where they are, we keep them where they are. The only reason we move loans is because we can do the equity strips, or we move you into our post-settlement care program, which is every 6-12 months we're reviewing loans where we can, equity releases where we can, LVR repricing where we can as well. And we're just trying to raise the bar for us internally, but ultimately as clients, you're the ones that are winners, and we can only win after they win, right? That's how this REM model works, which is you guys win, you guys build portfolios, we get them paid afterwards. You're telling your friends, family about us as well, and the circle just gets bigger. So if your intention is in 2026 to be a portfolio builder, then I'm saying reach out to us. I know, it's probably not the fastest to get meeting with us, which is why I say give everything more time. Like, how much time do you reckon to set up an SMSF?
A couple of weeks.
Yeah. And people, I was going to set up an SMSF. Yeah, the rollover.
Takes a couple of weeks. Yeah.
Yeah.
Everything takes time
Trust.
these days. Yeah, trust. Trust can be quick, but depends on your accountant, I guess.
And then depends on the lender that we go to as well, right? So just give things more time than possible what you think it needs. Why be hasty? Why be rash with decision making? Again, it's probably another portfolio killer that I see, which is chopping and changing strategies. Like, man, I'm buying here. When I'm buying here, it's, well, hang on. What are we buying? Where are we buying? What does this make sense in the portfolio, for example, as well? And again, if I come back to a fitness analogy, it's like 1 minute you're doing CrossFit, next minute you're trying to do a triathlon, next minute you're trying to do heavy lifting, the next minute you're trying to do F45. It's like, whoa, what outcome are you looking for? Okay, great, I want to be fit, healthy. What's your body composition? What do you do for a living? Like, you break it down that way and go, everyone's different. Don't look to social media for the strategy, for example. Get dialed into what you're trying to achieve, particularly if you're a couple coming together. You as a couple would have to have some very clear discussions around money, household, investing appetite. How hard do we push, for example? Not every idea is a good idea. And I think if that's the type of conversation that you want to have, mate, I'd love to help you on the journey. Otherwise, go to your broker, see what the roadmap is for you. And if they're talking that language, you've got a great broker. If they're talking 2, 3, 4 steps ahead of where you are, awesome. But if you're not, then I'll challenge you to go, mate, maybe it's time to think about moving and leveling up as well. And that's not us fishing for business, us just saying we're putting our hand up to help super, super ambitious Australians build portfolios and build intergenerational wealth. And that tune has not changed for years. So I want to say thanks very much for tuning in. We love when you guys reach out, drop us comments, for example, or DMs to say what's resonated. We'll talk to you next time. Thanks very much for tuning in.